Hey everyone, Jeff Dorman, Chief Investment Officer at Arca, back for another edition of That's Our Two Satoshis Live, where we talk about everything happening in the digital assets market for the week, as we have been every week for almost 7 years now. For those who prefer to read, you can check out our blog on our website, ar.ca/blog, and read the written piece. But we'll talk about what's happening here for the next 10 minutes or so as well. For those new, this is not investment advice, but of course we will be talking about the markets. So, sorry for being a few minutes late here. I was too busy fighting with someone on Twitter about MicroStrategy, but that's a whole nother issue. The short of it is I am just really tired of hearing about how MicroStrategy poses some sort of systemic risk to the market. $8 billion of debt backed by $43 billion of an asset and $63 billion of equity market cap is not a risk. It doesn't mean you should invest in MicroStrategy. I don't care what you do with the bonds or the stock and MSDR, but the actual threat of selling Bitcoin on the open market is just a non-factor. There are no debt maturities till 2028. There's no debt covenants that force any sort of liquidation. I've been saying this for 5 years. Can we please just get off this MicroStrategy selling Bitcoin narrative, because it is just false. I'm sorry. Sometimes I have to tap into my old investment banking days as a former debt capital markets investment banker and a high yield distress trader. This is just one of the dumbest arguments ever, and I'm just incredibly tired of hearing people talk about this. So in short, I don't care about MicroStrategy, the company. I do care about Bitcoin, and Bitcoin is not being force sold in any scenario by MicroStrategy. But that's not really what matters this week. What matters is, again, another terrible week for crypto. Everything's going lower. In fact, it's actually probably one of the most confusing investment environments we've ever seen. We've written for a couple of weeks and talked about the disconnect between sentiment and fundamentals. Which is weird, because typically the way it has worked in the past with crypto is fundamentals will start deteriorating first. You'll start to see lower daily active users, lower volumes, lower revenues, lower everything. And that will then lead to lower prices, which then leads to low sentiment. This is the first time in 7 years that I've seen the opposite happen, which is negative sentiment actually leads to lower prices, which then leads to lower fundamentals. So that's a little bizarre. We've never really seen that before. I don't really know what to make of it. What I do know, though, is that in addition to the disconnect between fundamentals and sentiment, we're also seeing a complete lack of correlation in the market, which is interesting, just because, you often hear about how digital assets are just speculation beta, which is a way of trying to discredit when rising crypto prices, saying that it's not really because of crypto, it's because they're just levered, risk to the NASDAQ or to other global risk assets. But you don't really hear much about it when that correlation completely breaks down, which happens just as often and is happening again currently. So, the true sign of an uncorrelated asset class is that short-term correlations come and go, and there's no real rhyme or reason to it, which is exactly what's happened. So over 7 years, we've highlighted all kinds of spurious and short-term correlations that crypto has had. Sometimes correlated with the NASDAQ, sometimes with gold, sometimes with the Chinese yuan or the US dollar or interest rates or AI stocks or money supply, you name it. None of these correlations have held over longer-term horizons. And again, what you're seeing right now, shout out to Bitwise with their new tool where you can graph any kind of rolling correlations you want, but just complete statistically significant correlations right now. We're near zero correlations with the S&P, near zero with TLT or the bond indexes, near zero with gold. So again, it's always just funny that you hear this all the time on the way up, but on the way down, when you just don't hear about it. So pretty interesting. And especially interesting because you may have noticed that gold is near all-time highs, U.S. equities are near all-time highs, credit spreads are at all-time tights. The VIX, even though it's up a little bit the last couple of days, has continuously been depressed. Interest rates are now down 50 basis points from the recent highs. The dollar has fallen 3% from the recent highs. And yet, digital asset market is just getting smoked. So what does that mean, right? There are times when the digital asset investing universe is actually ahead of the rest of the world. And sometimes you do see crypto acting as a leading indicator to other risk assets. Usually that happens over weekends or holidays, just because crypto is the only thing open at the time. It rarely happens over the course of weeks like this, where crypto is basically sniffing out some sort of a real risk, loss of risk appetite prior to the equity or debt markets. Typically, credit spreads are usually the best leading indicator for any kind of global sort of recession or depression or sell-off. And you're seeing none of that right now in credit spreads. So it is a bit odd. Most likely it's not real as a result. I think the market probably looks more similar right now to me to like May or June of 2021, where after a pretty big run up in the first 4 months of 21, You had this 30 to 40% drawdown. There were all kinds of swirling rumors, including MicroStrategy having to be a forced seller of Bitcoin, which again was not true at the time 4 years ago, and it's not true now. But there was all kinds of rumors at the time about why crypto was going to zero. And of course, it didn't happen. Over the next 7 months, crypto rallied to new highs again. So it does feel a little similar to that. But I think the other thing that may be interesting about the last week is that, and this again just kind of points to the immaturity of the crypto space and how there's no real value investors, outside of a few funds like ourselves that are looking at this stuff. So think about what happened last week. You had FTX beginning repayments to creditors as part of the bankruptcy reorg plan, which is going to ultimately distribute nearly $17 billion back to customers at 120% of the cash value of their account back in November 22. But obviously a pretty big haircut for real crypto investors because Bitcoin is 6x higher than where it was on the FTX bankruptcy date. Solana is 10x higher than where it was. Ethereum's 2x higher. So basically, even though you're getting your 120% of your cash value back, you're getting a significant haircut on what your Bitcoin, ETH, Sol, or whatever holdings are. So a pretty good reminder there, again, of just sort of the problems with centralized exchanges and lending groups and custodians. And literally at the same time, you had Bybit, a top 10 crypto exchange by volume, located in Dubai, was hacked, presumably by Lazarus in North Korea, for over $1.5 billion. So again, another problem at a centralized exchange. Now, it doesn't really affect the market because Bybit, like all exchanges, are flush with cash and it was easily able to cover the hole. But basically in the same week, you had a reminder that these centralized entities are real problems. And it's not just FTX or Bybit. We saw the same thing with Celsius and BlockFi and Genesis, and obviously even Robinhood and Coinbase have had issues with downtime and delisting assets. Binance has had problems in the past. Meanwhile, if you look at any graph of DeFi as a percentage of overall activity, it's at the highs you've ever seen. DeFi, decentralized exchange spot volume, is now almost 20% of overall volume, up from 0 4 years ago. Decentralized futures volume, led by Hyperliquid, now around 7% of total volume. In fact, Hyperliquid today did about 15% of Binance's volume. So just massive growth in DeFi. So logically, you would think, hey, something bad happened to Bybit, centralized exchange. FTX is a reminder of what happened 2 years ago with a centralized exchange. You would think that DeFi would rally at the expense of centralized. And in fact, the exact opposite happened. Binance Coin, BNB, which is the biggest centralized exchange, was only down 4% for the week. Meanwhile, Robinhood and Coinbase stocks fell 15%. And DeFi exchanges like Hype and Uni and Ray fell like 30%. So it's just, it's just bizarre, right? You would think 7 years into this, post, or really 8 years post the Ethereum ICO and the launch of smart contracts and all these different sectors that have grown, you would think that eventually there'd be a little more differentiation, and you're still just not seeing it. If you look at, and we put a couple of charts in our blog if you want to check them out. If you look at the price to sales or price to earnings ratios of a lot of these DEXs, these are trading at 2 to 3 times sales, way cheaper than Coinbase and Robinhood stock, and way cheaper than anything in the market. And you also had centralized exchanges failing. You also have massive growth engines, like the year-over-year growth of these DEXs is like 2,000% relative to the centralized guys that are more like 50 to 100%. So it's just strange, right? Logic would suggest that both growth and value investors would flock to this space, as well as rotation traders, given the recent spat of bad news at centralized counterparts. And the fact that it just isn't happening just shows still how early this asset class is, and when it comes to fundamental investing. So to me, it seems as clear as day that the road to DeFi is going to continue higher. But the road to liquid digital assets investing is still flashing detour signs as investors just still, for whatever reason, cannot differentiate the different assets and the different tokens in this space. So very weird environment, very tricky for investors as well. We're seeing the death of meme coins in real time, which is obviously pulling down Solana and to some extent Base. But again, in most markets, the fall of one area leads to a rise in other areas, whereas we just still aren't seeing that in crypto. I mean, even in the equity market right now, a lot of the recent weakness in the Magnificent Seven stocks, down almost 10% from the recent highs across the Mag 7. There's still pockets of strength in other sectors and other areas of the equity market. And, it's just interesting to me more than anything that you just still aren't seeing that in crypto. because of the misinformation and because of the lack of understanding of what these entities are. So I don't know when that changes. But we'll be buying all of these assets that have real revenues and real cash flows and are differentiated. And the jury is still out whether or not others will eventually recognize this as well. So that's it for this week. That's our 2 Satoshis live. Thanks for listening. Again, check out our blog, ar.ca/blog, and we will be back again next week. Thanks, everyone.